So currencies are driven and guided by three main factors. First one being fundamentals. So that is things like your PMI numbers, unemployment, basic economic data. So we have a economic calendar that is tracked and followed throughout the month. And these are very clear dates and days where a particular date or event is released. A really good example of this could be non-farm payrolls in the US. It's a very important figure that's released the first Friday of every month, which has a distinct impact on the direction of the market. The second thing is interest rates. And this is a hugely important point right now because we've been in a state of interest rate focus for a very long time, 2 years at least. That's been inflation versus interest rates, and one drives the other. So as we all know, we've had a big spike in inflation through a number of reasons, one being conflict, two being the aftermath of COVID, and that's driven monetary policy. When you have an incidence of high inflation, one of the main or most effective ways of bringing inflation down is to raise rates. Why? Because by raising rates, that stifles spending, or the economic theory is that it brings spending under control. Therefore, there's less money in the market. Therefore, the price of goods and services theoretically comes down. That has worked. We've seen US inflation come down to around 3%. We've now seen UK inflation come down to 2.3%. And the market now calls for a reduction in interest rates because inflation is now back to the target of 2%. At the current time, GDP is good, growth is okay. Stock market in the UK, for example, is very, very strong. It's at highs, all-time highs. If when we don't have an issue with growth and inflation's under control, there actually isn't an economic reason to reduce rates. So it's really interesting to see what the next decision, how the next decisions come out. If we are to cut rates, that has a negative impact on currency. Why? Because it reduces the yield of the pound or the dollar or the euro, whichever currency we're talking about. Why does it do that? Because when you look at fixed income markets, that is pegged to interest rates. Central bankers will be very cautious of changing these in just for the reason that it makes things cheaper for the consumer. That's not an economic reason to make that decision. So going forward over the coming months, it's going to be very interesting how central bankers react. And it's kind of a who goes first situation. Does the Fed cut first, the US? Does the ECB Euro cut first? Does the Bank of England cut first? And that's a really important factor when looking at the strength or weakness of any of those main currencies. So a big point at the moment is the election, the upcoming election, both in the UK and in the US. We have to tie that into how does that affect monetary policy? And how does the market interpret the likelihood for growth and economic stability once we have, let's face it, a new government in power? At the moment, the market is odds on a Labour majority. So the market is priced in the fact that Labour will get the majority. But what's been really interesting is when Rishi came out a week or two ago and said, I'm calling a general election on the 4th of July, the market didn't falter. The pound didn't fluctuate. There was no big movement. It almost didn't move. And that's a really clear indicator that the market's very comfortable. There's a theory called true market hypothesis or efficient market hypothesis, which basically the short answer of what that is the market prices in everything. The market knows everything. And when you have events like an election, if the market was unsure, there would be noise. There'd be a lot of movement, a lot of volatility. There's a lot of media conjecture around Trump's going to get in, and there are some very clear arguments from an economical point of view that Trump may not be bad for the US economy. So in terms of the US economy and the US election, in my opinion, it's too early to say right now. The focus is very much on the UK. Markets tend to focus on one or two things at a time. We've still got inflation, interest rates. That's still a big topic. For any individual moving money internationally during these times, during an election period, and actually at any time, the important thing to look at is the timescale of which that transaction is to take place. If it's real estate related, there's often a bit of a lead, and there's often 1, 3, 5, 6 months to consider. And I think my guidance is always to get a really good understanding of the market real time as it stands right now, and to understand why the market is trading as it is at that time. There's a propensity for anyone that's trading into currencies to focus purely on rate or the number. And actually, there's not a huge amount of value in that, because it's more important to look at where are the funds going to or coming from, what's the likely compliance friction associated with trading there, and is the necessary paperwork and rail in place to make sure that transaction is seamless. Remember, in the last 10, 15 years, the banking system or payment system hasn't got better, it's got worse. And that's mainly down to world compliance becoming incredibly strict. Therefore, there is an onerous emphasis put on paperwork, on reason for transactions, proof of wealth. Uh, and that's where, in my opinion, the real focus needs to be. We don't have that much control over the actual number that's achieved. It's important to know why the pound is trading where it is, where it's likely to be over the next 1, 2, 3 months, or whenever the client may be exposed. But we have little control when it comes to that. But we can take all the information we have available to help make the best decision we can. But there are no absolutes, and there's absolutely no right and wrongs in currency. Remember, markets there's only three things they can do: they go up, they go down, or they go sideways. And you ascertain where the market is given your time frame to help you make that decision around when to execute. But the real skill and value is in making sure that the paperwork and the friction is removed. And that's what the bank does a poor job of. Because they don't have capacity to have focus on a client's requirement and transaction real time. The FX market or industry has evolved from the banking system to a broker model, which is where you have what I would refer to as remitters, who do an amazing job at transacting smaller amounts of money. That's because compliance restrictions kick in only above a certain number. When the numbers get larger, compliance becomes particularly strict. Lucid exists to help people with the operational aspect of moving a large amount of money internationally, which can be very daunting. We provide a consultancy service that focuses on our clients' situation real time. We're essentially a custodian of the problem. We have focus on that transaction real time. So we don't just send a payment, hope it turns up. We have digital tracking. We're able to understand the ins and outs of where the funds are coming from and where they're going to, so that we can make the best recommendations. The most important thing we do is make sure that the client has complete visibility on their money from end to end.